You've heard it on the news, you've seen it in headlines. Politicians love quoting it. GDP grew by 1.2%. GDP contracted in quarter four. Canada's GDP is the envy of G7. But hand on heart, do you actually know what GDP even means? Most people don't. And that's not your fault. Nobody teaches this stuff. Today, we're changing that. By the end of this video, you'll understand GDP better than most adults in this country. Let's get into it. GDP stands for Gross Domestic Product. In plain English, it's the total dollar value of everything a country produces in a year. Every product made, every service sold, every coffee poured, every house built, every haircut given, every software subscription sold. All of it added together. It's basically the economy's annual report card. Here's a simple analogy. Imagine Canada is a business. GDP is its total annual revenue, a snapshot of how productive and active the whole economy was over the year. In 2026, Canada's GDP is expected to grow by 1.2%. That means our economic revenue as a country is 1.2% bigger than it was last year. Now, is that good or bad? That's exactly what we're going to unpack today. There are three main ways to measure GDP, but the most common one you'll hear about is the expenditure approach. It adds up four things. 1. Consumer spending. Everything the Canadians buy. This is the biggest piece. 2nd, business investment. What companies spend on equipment, buildings, technology. Number 3, government spending. What Ottawa and provinces spend on services and infrastructure. Number 4, net exports. What Canada sells to the world minus what it buys. Right now, in Canada, consumer and government spending are holding the economy up, while exports and business investments are being dragged down by trade uncertainty and US tariffs. That's why the number is only 1.2%. Strong in some areas, but very weak in others. Think of GDP like a health check for economy. A growing GDP generally means more jobs, higher wages, and more business activity. People are spending, companies are hiring, things are moving. A shrinking GDP means, especially 2 quarters in a row, is what we call a recession. People are spending less, businesses are cutting back, and unemployment is rising. This is the scenario every government tries to avoid. Now, here's something really important that most beginner explanations skip over. GDP growth isn't evenly felt. Canada might grow 1.2% on paper, but that doesn't mean every Canadian is 1.2% better off. GDP can grow because a small number of wealthy people or large corporations are doing extremely well, even while average families are struggling with groceries and rent. That's why economists also look at GDP per capita, GDP divided by number of people. It gives a better sense of average living standards. And they look at who actually gets the benefits of the growth. So sometimes when politicians say, the economy is growing, it's worth to ask, growing for who? So, Canada's 1.2% GDP growth forecast for 2026. Is that something to celebrate or worry about? Honestly, it's modest. It's okay, but not very exciting. For context, Canada's economy typically aims for around 2 to 3% annual growth in healthy times. We came out of 2025 with a meager 1.6% growth, and 2026 isn't looking much stronger. The culprits, US tariffs, are slowing our exports. The trade uncertainty is making businesses hesitant to invest. The housing sector is still soft, and global oil price shocks are creating inflation pressure at the same time as slowing growth, which is a very, very uncomfortable combination. The good news? Canada is still growing. We're not in a recession, at least yet, and government spending on infrastructure, housing, and new programs is helping keep things moving. But it's a fragile moment. And that's exactly why understanding these numbers really matter. So, what does GDP mean for your life? When GDP grows strong, employers hire more, which is good for your job security and wages. When it slows, layoffs increase and raises become harder to get. When GDP shrinks, the Bank of Canada tends to cut interest rates to stimulate spending, which can lower your mortgage costs. When it grows too fast, they raise interest to cool things down. GDP is literally the foundation that every other economic decision, interest rates, government budgets, employment policy, is entirely built on. Now that you know what it is, when you hear Canada's GDP grows 1.2% in the headline, you'll know exactly what that means, what caused it, and what it signals for your personal financial life. And that is the power of financial literacy. So, to recap the entirety of the video, GDP is the total value of everything Canada produces in a year. It's our economic report card. And growing GDP generally means a healthier economy with more jobs and opportunities. Canada's current 1.2% growth is modest, held back by trade tensions, tariffs, and global uncertainty. In the next video, we're tackling the word that makes every economist sweat: recession. What it really means, how to spot one coming, and honestly, is Canada heading towards one? Subscribe so you don't miss it, drop a comment below, and I'll see you in the next video.